right. Welcome everyone to today's webinar. Excited to have you. Got a wonderful guest here to speak with us today. We're going to be talking about sticking to the plan. This topic's been top of mind for a lot of us and a lot of our advisors with elections coming around, uncertainties in the market, and just the tumultuousness that comes with life. It tends to when it rains, it pours. So we're going to be talking through that today, how to stick to the plan. Alan, we're really excited to have you here today. Thank you for being here. By way of introduction, Alan Skrainka is currently responsible for our managed research, or our manager research, rather, at Mariner. His team conducts due diligence on investment managers, mutual funds, ETFs, and they run quite the suite of model portfolios that are available to our clients. Alan is a 41-year veteran of the financial industry, spending all of his time in research. So definitely an expert in the area. He's a chartered financial analyst, holds an MBA from Washington University in St. Louis, and has taught retirement planning classes at the University of Missouri. He's also author of the book, Principle-Based Investing. Really excited to have you here today, Alan. Thank you for being here.
Well, thanks, Dylan, and thanks for that kind introduction. I think the message of our program today is we think investing success really does depend on sitting down with your wealth advisor and developing a well thought out, sensible long-term plan that can help you meet your long-term goals, then sticking to that plan in good times and bad. Of course, as you mentioned, that's always easier said than done, especially with all the distractions in our world today. And, I'll just give you an example. Tune into any financial news program and you'll hear these questions being asked. What stock should I buy now? What's the Fed's next move? Is the economy going to slip into recession? Or what if insert really bad thing here happens? And the people trying to answer these questions are well-meaning, they're well-dressed, they're articulate, and they, of course, do their best when trying to answer those questions. But there are three problems with this approach to investing. The first problem is it's all conflicting advice because no one can agree, so you don't know who to listen to. Second, the answers change every day, if not every minute of every day. And third, the biggest problem of all, no one can predict the future. It's guesswork. And it's impossible to stick to the plan if the plan is changing every day. So how do you develop a sensible long-term financial plan when all the advice seems to be based on short-term predictions and speculation? Well, I think the first step is to recognize that long-term investment decisions cannot be based on short-term predictions. They should be based on long-term investment principles that have stood the test of time. And the first principle that we're going to talk about is maintaining a long-term perspective. Maintaining a long-term perspective allows us to remain calm in times of trouble. We think time is an investor's greatest ally, emotion his greatest enemy. Patience and humility, we think, are the best ways to guard against the emotions of fear and greed. But the truth is that emotions often drive investment decisions. Most people like to buy when they feel good. And this is usually when the market's going up, the economy's doing well, maybe you just got a big promotion at work, or your spouse remembered your birthday. And people like to sell when they feel bad. Often this is after the market takes a big tumble. And the problem with this approach, clearly, is it can lead to us buying high and selling low. Now, look back at history tells us the future is always clouded with crises, problems, and uncertainties. In fact, since the beginning of time, every year, year after year, there are always reasons not to invest. In fact, the market has been in a correction, a bear market, or a recession 42% of the time, or nearly half the time in the post-war period. Now, maybe you'll tune into the nightly news tonight and they'll tell you, hey, everything in the world is going really well. Everybody's getting along. It was a great day. But that doesn't happen a lot. We always have problems and challenges that as investors we're trying to face. And we can actually measure the cost of trying to predict the short-term direction of the market. This study, which goes back more than 40 years, shows how much of your return in the market that you give up if you just miss the 10 best days. That's not 10 best days a year. That's 10 best days over the entire 43-year period of time. If you just step to the sidelines a little bit because you're concerned about the future and you miss these 10 best days, your return is cut in half. Instead of a $10,000 investment growing to 1.4 million, you would have less than $700,000. Miss the 50 best days over 43 years, and your return would be closer to that of a T-bill. Now, why does long-term investing work? Stocks rise over a long period of time because the economy is growing most of the time. This chart shows the US economy has been growing 86% of the time in the post-war period, 90% of the time since 1982. And the reason why is each and every day in America, about 150 million people get up and they go to work. And when those people get home from work, they often spend their money, and that money is measured by the value of all goods and services produced in the United States, what we call gross domestic product, or GDP, which is the line you see here. Now, where does that money go? Well, once expenses are covered, that money is reported collectively as corporate profits, which you see here. And collectively, at least in most years, those profits are rising. And those profits have a tendency to act like a magnet, which pulls stock prices higher over the long run. Now, but what about those gray bars, those recessions that always seem to be being predicted and they're just around the corner, they're always on the horizon? Well, their impact may not be as serious as you would think for the long-term investor. This study shows what would happen to an investor who had the worst luck in the world, investing $10,000 on the first day of every recession. Well, on average, that $10,000 would still have tripled in value and be worth a little more than $30,000 10 years later. Now, what if instead that investor was the greatest economist in the world with an uncanny ability to predict the future? Let's say instead of investing on the first day of every recession, this investor invested $10,000 on the last day of every recession. What's the difference in performance between these two investors? Well, believe it or not, the difference is almost nothing. Now, how could that be? Well, the reason why is recessions tend to be very short and expansions tend to be very long. On average, over the past 100 years or so, recessions, shown here as the red bars, lasted just 14 months or a little over a year, while expansions lasted 48 months. What is especially impressive is the difference in the bars in the post-war period, where recessions have continued to be very short and expansions have grown even longer, with 2 of the last 5 expansions lasting more than 120 months or 10 years. Now, we all know the economy doesn't grow all the time, just like the stock market doesn't go up every day. Investing is not all about sunshine and rainbows. We do have the occasional storm, and some of those storms can be quite painful. Over the past 100 years or so, going back to 1928, we have averaged 3 or 4 dips of about 5% per year, one 10% correction every year, and a serious correction once every 2 years, and a real bear market defined by a drop of 20% or more once every 3 or 4 years. So, what are the most important lessons we can take away from this history? First, we have to understand market declines are normal, frequent, and not a reason to sell good investments. They happen all the time. And not every dip, by the way, in the market is going to be the big one. Second, market declines begin and end without warning. No one can predict them. And third, we think market declines can be the long-term investor's best friend because they give you the opportunity to buy good investments at a lower price. And of course, if you can't predict, you must prepare. So, how do we prepare for market downturns? Well, it starts with the second principle I'll mention, which is the principle of diversification. So, baseball season is underway, and I'm sure all of you are big fans. So let me ask you this question. Why are all these players spread out? Well, of course, they're spread out because they don't know where the ball is going to be hit. So here you see my favorite team, the 11-time world champion St. Louis Cardinals. And here you see the alignment for the hapless Kansas City Royals. That's okay, Kansas City. You still have a great football team. But just like a baseball team, your investments have to be in different places. You have to be diversified because the future is uncertain. And just like you don't know where the ball is going to be hit, you don't know what's going to happen next in the economy or the financial markets. Now, we all know historically that stocks have provided the highest returns over the long run, but that doesn't mean we invest everything in the stock market. So how much is appropriate? Well, this gets to the asset allocation question. And there is no perfect mix for every investor. This is something, of course, you can determine with the help of your wealth advisor. But in its simplest form, it's a trade-off between return and risk. And this slide is based on the assumption, which I think is reasonable, that stocks return 8% annually over the long run, and bonds return, let's say, 4%. Now, no one really knows what those numbers will be in the future, and you could argue that's being a little conservative. But the point is, bonds are an important piece of the portfolio. While the returns tend to be lowered by adding bonds, current income is higher and downside risk is lower because bonds can dampen the blow when the stock market falls. So the higher your weighting in bonds, the less your potential return. But your potential loss is also reduced, as you see in the chart on the right. This shows the potential short-term setback in your portfolio if the stock market falls 25%. Now, when I show these charts side by side, risk and return, many investors choose something in the middle. Now, of course, with a decision this important, we have a lot of great tools that get into more detail, considering your taxes, your investment time horizon, and other objectives. So this is just meant to simplify an otherwise more sophisticated approach. But you get the general idea. Diversification can help, doesn't prevent a loss, but it's an important tool in managing risk and dampening that stock market volatility. Now, once you determine your asset allocation, portfolio rebalancing can help keep your portfolio's level of risk consistent through the cycle. This example shows a portfolio that has 60% stocks and 40% bonds in 2003. With no rebalancing, the market pushed the stock weighting up to 69% stocks right before the financial crisis in 2007. In other words, this portfolio has too much risk at just the wrong time. Then when the financial crisis was over with no rebalancing, the 60-40 portfolio became 50-50. So it had too much in bonds, too little in stocks, right when the stock market starts to recover in 2009. The result of disciplined rebalancing over the long term is that it tends to reduce the risk of your portfolio and keeps your mix of investments right where you intended it to be. Overall risk is reduced because over the long term, riskier asset classes such as stocks tend to go up in value and become a larger and larger percentage of the portfolio. That increasingly raises the portfolio's level of risk with more downside potential when markets become volatile. So periodically rebalancing back to the targeted allocation helps avoid letting the portfolio drift to a higher or lower risk allocation than intended. We think rebalancing is a much better strategy than trying to guess where the market's going to go and can help you manage the risk in your portfolio. And remember, like this slide shows, if you don't rebalance, the market will do it for you, and you may not like the results. And the last principle I'll mention is to focus on quality investments. Quality investments are investments that have stood the test of time. They're like tennis balls. When the market goes down, they'll fall, but they also have a tendency to bounce back when the market recovers. Speculative investments are like eggs. When the market drops, they just make a mess. So you don't want to own investments today you would not want to own in a bad market tomorrow. I think the two biggest mistakes investors are making today are reaching for yield, because high yield often means high risk, and chasing investments that have the strongest recent performance. And again, your wealth advisor can help you understand how your portfolio is invested, how well it's balanced, and how much your portfolio is in quality investments versus low quality investments. Remember, there are two goals to professional investment management: earning a competitive return and managing risk. And if you don't manage risk, you'll never earn a competitive return. So what do you think? Do you see danger ahead? Are we about to hit the iceberg? Well, I often ask investors, what do you think caused the Titanic disaster? And of course, they usually say an iceberg. But that's not the whole story. You see, no one predicted an iceberg could sink the Titanic. The ship was thought to be unsinkable. The reality is, overconfidence played a big role too. And because of that overconfidence or lack of humility, Titanic only had 20 lifeboats, and that was only enough to rescue half the people on board. That was the real cause of the disaster. So if you can't predict the future, you have to prepare. You have to be humble. And the best way we know to prepare is to have a sensible plan in place and to stay focused on the factors you can control, the investment principles we've been discussing. First, maintain a proper asset allocation. Know your risk tolerance and asset allocation, and discuss this with your advisor before the next correction. The best asset allocation for you is one that helps you reach your long-term goals and one that you can stick with in good times and bad. Second, maintain a long-term perspective. Corrections are a normal part of the investing process. Remember, time in the market is more important than time in the market. Third, diversify. Your portfolio should be broadly diversified by security, by asset class, and by manager. And finally, focus on quality and consider the importance of professional management. Make sure your portfolio is high quality and professionally managed, monitored, and rebalanced. And don't reach for yield or chase past performance. Remember, predictions are useless. Principles must guide us. Dylan, I think knowing and understanding the lessons of history gives us the confidence and provides a guidepost to make well thought out investment decisions. Call me an optimist, but I think to be prudently hopeful or sensibly optimistic in difficult times is not casual or careless. It's a strategy that has won the day time and time again. And I'd be happy to answer any questions that folks might have.
That's great. Perfect. Thank you. And we have had a number of questions come in, so we'll get to those in just a moment. This is a wonderful presentation. Now, I love the information that you've gone through. And I'd also like to note that a lot of the data that we're looking at here is not unique to Mariner. A lot of the data that we're looking at is data that's been resourced and reviewed by peers within the industry as well. This is economic data that's used industry-wide. It helps to inform decisions for a lot of firms and for a lot of investors. So thought it was important to highlight that as well. Now, one of the questions that we've had as we've come through, kind of to start off with your first, I guess your last statement about optimism. Where do you draw the line between optimism and naivety when we're looking at investing and preparing for the future?
Sure. Well, Dylan, if I was just an optimist with rose-colored glasses, I'd of course put everything in the stock market and maybe everything in those Magnificent Seven stocks that have done so well lately. But I think diversification is a symptom of humility. I think making sure that owning individual stocks and bonds. I own mutual funds, I own ETFs, so I have hundreds, if not thousands, of stocks and bonds. I think that shows some humility too. So, and we of course own bonds. So, I think having that balance, having that diversification, is there because, if I'm wrong, we do get into difficult markets, and those difficult markets are prolonged over a period of years. We're still going to have income in the portfolio, and we're going to have investments that will recover when we get the good times back.
That's great. Now, when we're talking about these time frames, recovery, expansion, bear markets, bull markets, how long-term is long-term? What kind of time frames are we looking at?
Yeah, I have a lot of older investors that'll say, I don't even buy green bananas. And I know they're joking, but I get the point. How long term is long term. And, I think it's important, to really think multi-generationally. A lot of investors, a lot of our clients here at Mariner, um, their assets are going to be passed on to the next generation. And so we want to own investments that really are going to do well over a very long period of time. Um, I think for most investors, long term is at least 5 years. I don't think if you can't commit that money for at least 5 years, I don't think it should probably be in the stock market because, we don't want to put money in that we have to take out in a year or two because the market could be way down. And so, yeah, I think at least 5 years, but hopefully longer than that. Hopefully we can put together a portfolio that lasts a lifetime or longer.
That's great. Now, a question that I'm sure you've heard a lot, and I know I have in my career as well, is how do you know the difference between being patient and sticking to the plan through downturn and standing in front of a moving train, right?
Yeah.
When do you make that decision between holding on or selling positions?
Yeah. Well, the market historically has always recovered, but I think it's also important to address this question with regard to individual investments because, we all make mistakes. I've made mistakes. You've made mistakes. And sometimes you buy an investment and then you start to realize, maybe this is just a mistake. At that point, I would go back to the original reasons why you bought that investment. In our case, we research a lot of mutual funds. We talk about not just the performance of those funds, but the parent, the people, the process. And our team goes through the reasons why we originally recommended that particular investment and have those reasons changed. Maybe a portfolio manager is retired. Maybe the team is split up or maybe there are other reasons why we might want to sell that investment. But it's not a reasonable reason to sell just if the recent performance is just disappointing. And so I think you got to go back to the fundamentals, the fundamental reasons why you bought that investment, and how many of those important reasons, long-term reasons that you bought it, have really changed.
That's great. And talking of assessment, we're assessing investments. I want to talk about assessing ourselves for a minute here. When we're looking at making plans and investing, we talk often about risk tolerance. What's the best way to assess our own risk tolerance outside of maybe some of the technical aspects of just understanding what our tolerance for that risk is really going to be? And when would you say is the best time to make that assessment of risk tolerance?
Yeah, this goes to the issue of risk tolerance, and your answers to me, those questionnaires often change depending on what's going on in the world. Maybe, people come in the middle of a financial crisis and say, I can't take it anymore. So many, if not most of our clients, this isn't their first rodeo. So they've been investing money for a while. And, I would think back to some of these really difficult times that we've had, like when the pandemic struck in 2020, or the financial crisis back in 2007. What did you do? How did you react to that? Did you keep a cool head? So, we said in the presentation, the best asset allocation is the one that helps you reach your long-term goals. And it's also the one that you can stick with in good times and bad. So don't set an asset allocation just when everything's going great. You really got to ask yourself, am I going to stick to this asset allocation if we get into a period of time where we have a couple of difficult years?
Well, that's great. And speaking of those asset allocations, with interest rate environments being what they are, there's been a lot of talk around the impact of interest rates on pretty much every type of investment you can think of. When we're thinking of those more traditionally conservative asset allocations, the bonds, those types of investments that are meant to protect and shelter a little more than just generate return, right? How do we handle those bond portfolios given interest rate environment? Should we be treating those differently or using alternative investments in lieu of bonds to create some security without standing in front of the proverbial interest rate train that we're dealing with right now.
Sure. Well, alternative investments can play a role. It's very specific to each individual investor. For some people, they're very appropriate. For others, they may not be. Many alternative investments are illiquid, so they can't be bought and sold on any busy business day. So, that's something you got to really be aware of. Um, but there are a lot of questions about bonds, right? We have just been through an incredibly unusual period for the bond market. I think 3 down years is almost unheard of when you go back throughout history. And so a lot of people have a bad taste in their mouth because their bonds have not done well the last couple of years. But a real indicator of what future returns for bonds will be is the starting interest rate. And we're not at the 2-3% we were at a couple of years ago. We're at a much healthier level today. So future returns should be better. You don't want your bonds to look like your stocks. So a lot of people that are reaching for yield or getting into some of the more exotic alternatives really need to understand the underlying risk. If these are bonds of companies that have a lot of debt on their balance sheet, their value may fall a lot if we go into a recession. And so let bonds play the traditional role they're supposed to play, which isn't to earn the highest return. It's to provide some income and to provide some stability when the stock market declines.
Now, to that end, as an observation as well, it's always interesting to me when working with clients how these more exotic alternatives that you're talking about tend to pop up during tumultuous times in the market when the Fed doesn't move forward with reducing interest rates or bad news comes out. You see a lot more advertisements for gold or this alternative or that alternative. And I think that that fear response can definitely play into the composition, the perceived need for a composition change within a portfolio. And when you're talking with clients and you're looking at the perspective that they're seeing, how do you work with them on that? Or here's a better way to phrase that. What would you expect from a manager who's working with a client to do for them in that situation to help keep them on the path and give them the appropriate perspective to maintain their asset allocation rather than chasing whatever the new promised alternative is?
Yeah, as humans, we just want to tinker, right? We just really want to do something when the best strategy sometimes is to do nothing. Back to that patience and humility. So it's okay to add some of these lesser correlated assets to the portfolio. Just judge them over an entire business cycle. Don't just buy what's done well over a period of time when maybe the stock market went down. Um, you know, Inflation is always with us. It's a menace over a very long period of time. And so you're going to need investments in the portfolio that grow, that can increase dividends, that can benefit from raising prices, can protect against that inflation. Um, Gold has really not been a great protector against inflation. It's been incredibly volatile. I like to say you can buy a fine men's suit for an ounce of gold today. The same was true in Shakespeare's time. I've actually done the research on that.
That's wild.
Going to 400 years. Yeah. So at best, it's maybe kept up with inflation, but that 2 to 3% return over long periods of time is pretty miserable when you think about how the cost of living is rising and compared to how stocks have performed.
Yeah, that's great. And there are a number of questions regarding market volatility, and there seems to be a theme with a number of them is it's two parts. One, how do you assess a manager? And I think your position as well, Alan, your history of assessing funds and ETFs and management profiles, I think you'll lend some unique perspective here. But when you're looking at one, a manager, how do you assess a manager and their ability to navigate these types of markets? And then two, where do you view the importance of a manager lying? What's the real value add that they can bring to the table?
Yeah, well, we assess managers by looking at the 5 Ps: the parent, the people, the process, the performance, and the price. Uh, Regarding the parent, we want companies that have the resources to support the managers with an army of research analysts and the ability to visit face to face with the managers with companies that are in the portfolio. Um, the people, we want people that are experienced, credentialed. We want the teams to be broad and deep. We want the process to be a repeatable process that really emphasizes buying undervalued stocks and bonds and not timing the market. Um, and we look at the performance in good times and bad. It's important to offer competitive return, but it's also important that they're managing risk through the down cycle. And then the price, it's okay to pay for investment management, but we want the price to deliver good value for the price that we're paying. And then when we build a model, we're going to diversify that model by manager. We like diversity of thought. We like diversification by manager, by asset class, by security. And so all that goes into the process, not just for mutual funds, but for all the investments that we offer.
That's great. Now, when we're talking about diversity of thought, a question we often get, and this is going to be different from institutional perspective, meaning having multiple managers all attached to the same kind of plan versus the individual themselves having management. One question we often get, and one we've got here in the chat as well, is what do you think about diversifying actual investment managers for individuals beyond 401k plans and more institutional money? Is there a place for that for the individual having a diversified book of managers working on their personal investments?
Well, of course, that's a personal decision. If you're going to use more than one wealth advisor, for example, you better make sure that the left hand knows what the right hand is doing, and you want to make sure that they're not working at cross purposes. So when we talk about diversity of thought, we're really talking about within the portfolio. We're not going to put all the money in one mutual fund or one parent company, for example, because someone's predicting the economy or interest rates. And they're wrong, the portfolio is going to take a big dip. So that would be my response.
That's great. And I think there's also something to note where terminology can be a little confusing and potentially misleading sometimes. For example, manager could mean something different to different people, right? You could be talking about a wealth advisor on one hand. You could be talking about a literal 401k manager or a mutual fund manager, or there's a whole plethora of different types of managers. I think one piece of advice for anyone who's interested in learning more about that is making sure you got the terminology right, making sure that you know what the individual on the other side of the line is actually going to be able to do, what the plan is. And I think something that you spoke about before is really key to this is understanding where you need to be going and that there's a clear plan to get there. And there needs to be a plan. You need to have a clear path to action and have someone in your corner that's going to be able to help you get there.
Yeah. And that's the role of the wealth advisor. And of course, when I'm talking about managers, I'm talking about mutual funds and ETFs and so forth.
Yeah. Thought that would be a helpful point of clarification there.
Right.
Now, when we're looking at a couple, we've actually had a number of questions come in about some alternative investments. I'll try not to put you too much on the spot here, Alan, but there are questions about things like options and cash secured puts, if those would be appropriate alternative investments when looking at something that might potentially replace bonds or act as a substitute for bonds within a portfolio. And obviously beyond, of course, it depends on the individual, but just from a general high level principle based kind of perspective, love to hear your thoughts there.
Yeah, it can be very uncorrelated. It can provide income and I think the key here again is that professional management. And I know we've got a great options team. We've got several offerings that I think have done really well. And so, not appropriate for everyone. It's something you really have to understand what you own and why you own it. But that certainly can be an alternative that makes sense for some investors. Sure.
Yeah. Now, when we're talking more broadly speaking, we're looking at the market, demographics of the economy that we're living in today. One question that came in that I thought was interesting that I'll read for you here was when we're looking at the quote unquote rise and fall of the baby boomer generation and the impact they have on stock and bond trends. You had mentioned a general market rise since 1957. How do you view this potentially changing as the baby boomer generation fades out and as demographics change moving forward?
Yeah, I remember back in the 90s, there was a strategist or guru that became very popular that based all of his forecasts on demographics and showed these charts of the baby boomers and how it correlated with the stock market rising. And he predicted this massive crash in the stock market. This was maybe about 30 years ago. And of course, we don't see much of them today because I think that theory has been quite discredited. And while we do have an aging population in developed countries, I think the opposite is the case in the emerging market economies. And this isn't to go out and recommend everybody put money in emerging markets, but it's a global economy, right? And so as older workers exit the workforce, we're going to have a lot of younger workers enter the workforce. And with technology today, those workers could be located anywhere in the world.
And speaking of kind of global focus here, when we're looking at things like government debt and the impact that that has on worldwide economics, when we're looking at short-term versus long-term, short-term, of course, anything can happen. There's a lot of volatility that can happen short-term, but when we're looking at that long-term strategy and long-term performance, how do you see governmental debt affecting that, and what level of concern should we have for its impact within our investments?
Yeah, there's a strategist I really respect out there. His name is Ed Yardeni, and believe it or not, he's older than me. He's been doing this longer than I have. And I remember hearing him speak maybe 25 years ago when this was a big concern on people's minds. And he said, I heard that theory, many years ago that, government debt would get so big, it would crowd out the private sector, interest rates would soar. And here we are, so many years later, still worrying about it. So I don't totally discount it. I do think government debt and the increasing deficits are unsustainable. I do think at some point, way out into the future, we may have markets sort of respond to the increase in growing debt, and then we'll have the blue chip commission put together and compromise on both sides. It reminds me of the financial crisis. Congress didn't act until the markets made it clear they had to, with a big drop in the Dow, and so that got addressed. So no, I don't. I'm a fiscal conservative. I think we have to get our house in order. We've got to slow the rate of spending relative to the amount of taxes we're collecting. But no one seems to want to talk about today. So at the end of the day, I think the markets will have the final say, and the politicians will have to correct their current course.
Now, a little bit of a tangent here, but had a number of questions come in regarding cash savings. So the first question I want to talk about is kind of the how much money should I have hidden under my mattress kind of question. So one was a general question about how much money should I have saved aside, depending on the market and environment, assuming all things are equal. But two, can cash be a ballast for the portfolio? Can that be a conservative allocation that can help support a portfolio, or is that a bad idea?
Well, no, cash, first of all, is very specific to the individual investor. Different investors have different cash needs. And so that's something that drives the decision. I think the biggest mistake investors are making today with cash is not understanding the lessons of history with regard to the Federal Reserve. When inflation goes up, when inflation spikes, the Federal Reserve hikes interest rates very aggressively and puts the brakes on inflation. And it doesn't always happen as quickly as we would like, but it always comes back down. And so if you have too much of your portfolio in short-term cash investments, nothing's locked in. And so you have this reinvestment risk where the rate is falling very dramatically. And then you say, well, then I'll move money into the stock and bond market, but then it's too late because the markets have gone up. I've kept one of my favorite investments was a certificate of deposit from 1983, 15.8%. And it was a
Wow.
5-year CD. And it was maybe my first investment I ever made. And of course, guess what happened? That CD came due, and rates, of course, 5 years later were much lower, and they fell, and then they fell again. And so you don't have anything locked in. It's fool's gold. It looks too good to be true. It looks like a riskless investment where you can earn a high 5% return, but the risk is that the Fed starts cutting rates, and because you're not locked in, your rate of return will fall very dramatically.
So a similar vein then, we often talk a lot about market risk, standard volatility risk. What are maybe the more common other types of risk that you see investors fail to consider within their planning and their investment strategy?
So there are many, many sorts of risks. I think one risk that we haven't really talked about is, investors will own mutual funds, and then they'll tilt that portfolio to the best performing mutual funds, not realizing that they've now overweighted in the growthy technology sector. And then maybe they'll go out and buy some stocks that they're really excited about, like the Magnificent Seven technology stocks. And so if you did a comprehensive portfolio review, you discover that everything's on one side of the boat. You've got way too much in growth, way too much in technology. And investors have a tendency today to sell international, to sell value, to sell out of small caps because their recent performance has been very poor. But one thing we know for certain is markets always cycle. And so you don't want to make the mistake of buying what's had the best 1 year, 3 year, 5 year track record. Every manager has a style. Every style has a cycle. And if you're just buying what's performed best over the past 1 year, 3 or 5 year, you're buying high and you're selling low. And you just got to combat that tendency to do that and maintain good balance in your portfolio.
Yeah, we don't want to do that. We don't want to buy high and sell low.
Right.
That would be painful doing that more than once. Now, one question that we had come in, another bit of a tangent here, but when we're talking about these companies, a lot more access to information, a lot more access to CEOs and board members and leadership within companies than we've had historically. It was a lot more indirect in the past. One particular example being Elon Musk is one that is in the news fairly often, probably more than Tesla would care for. But when we look at the behavior of CEOs and leadership within an organization and potential red flags, how often, in your opinion, and you can feel free to let me know if this is something that you can't even speak to in detail, but when we're talking about short-term versus long-term impact, where do you see CEO behavior falling on that line? If they have
Yeah.
red flags, is it more a short-term jump or drop depending on emotional reactions to their behavior, or do you see it potentially having more long-term ramifications for companies?
Yeah. So, I worked in a stock research department for much of my career. And
For a
so
minute.
yeah, so this is a conversation we have with a lot of the analysts and portfolio managers that we talk to on a daily basis. And, one good rule of thumb is we have a tendency not to like CEOs that have a lot of charisma. And so if they're out there in front of the cameras, if they're, expressing strongly held views about politics and so forth, that can lead to trouble. In fact, you mentioned Elon Musk. I mean, Tesla's latest sales indicated that a very large portion of their customers that don't agree with his politics aren't buying Teslas now, which is the reason behind a lot of the big sales drop that they recently had. And that's not a recommendation on the stock. That's just an example of where a CEO can have a negative impact by being out there on Twitter too much. So this is something we talk about with our managers a lot. Management is a key variable when they're evaluating those companies. There's a lot of forecasts and assumptions that go into picking stocks, and that's why, again, we like to have a variety of managers, and those managers have a whole bunch of stocks. We have a tendency to avoid mutual fund managers that have 25 or 30 stocks in the portfolio. We think you need more diversification than that.
Yeah, that makes a lot of sense.
Yeah.
Now, last question here, and we'll wrap it up with this, and I think this will be a good one to end on. But for the retiree, especially the new retiree, where we've had unprecedented amounts of downturn. We've had COVID recently, we had lockdowns, we've had volatile markets, and they're withdrawing money. And this is the beginning of their retirement adventure, or it's supposed to be an adventure, right? And it can feel a little bit more like a nightmare when we're facing these kinds of markets. You spent your life saving. Now I'm supposed to be pulling from this money, but the market's going crazy. How would you recommend looking at that scenario and managing that, between making sure that, one, you're not making rash decisions, of course, but two, understanding what the purpose of the withdrawal is within the plan, and how to navigate that uncertainty without feeling like you're damaging your portfolio?
Yeah. Well, it can be a very stressful experience, right? Especially for recent retirees. The point we made during the program was downturns tend to be pretty short. I think we showed, the average recession is about 14 months. They happen with common occurrence, but they don't last forever. And I think, back to your question about cash, our points about liquidity, this is the whole point of the program today. Stick to the plan. Is we need to have these conversations before we have a downturn in the market, so that we know which assets we're going to tap for liquidity, whether the market's going up or whether the market's going down. So to have a prudent strategy for withdrawals is part of a comprehensive financial plan. And again, it's very specific to the investors. So those are conversations that we need to be having before we have a prolonged downturn in the market.
That's great. And thank you, Alan. I think that's a great place to go ahead and finish off here. Wanted to thank everyone here for participating. Love all the questions that we had coming through. I thought this was a really worthwhile conversation. And again, Alan, thank you so much for your preparation, and as well as the presentation, of course. For anyone that has any remaining questions, feel free to send them our way, to Mariner in general or to your advisor. We'd love to talk to you, answer any other questions. And until then, we will catch you next time.